as we talk about the way that the markets are setting up, we are record highs here in the stock market. Is there any reason why we should think that this run cannot continue?
I mean, at least on the fundamentals, I don't think so. I think the economy, both the U.S. and the globe, continue to grow. Again, maybe a bit of slowing on both parts, but not near any part where you'd worry about recession. Certainly the earnings backdrop is very good. Obviously the good news to start the week on the trade front, I think the place where you keep an eye out is certainly if trade deteriorates again. China is a big part of that. I think there's some good feelings that, hey, we're not starting trade wars everywhere. We've got some things done, but we'll see how China plays out. Certainly the domestic political issues here could play into some volatility as well.
All right, Bill, as we talk about the way that current political environment is shaping up, is it fair to say that the midterm elections are going to be a big market catalyst, or are we making too much of it? Do we see a real handicapping, so to speak, in real time of what's happening with those anticipated election results?
I think the hard part is, at least what I've watched, the market is already assuming that the Republicans lose the House. So, when that's already seemingly being priced in some of the other markets, I think that maybe it's not as big a deal. Now, the place where at least some work I've done is in times when you've had impeachment proceedings start with, say, Nixon and Clinton, and I don't know if that's the direction things are going to go, but it's something as due diligence that I've got to do as an investment person. You have seen some market turbulence. The hard part is it's never just one thing, right? Nixon, they had the oil embargo ahead of that. In Clinton, we had Russia getting close to default. You had long-term capital management collapsing. So it's hard to separate the two. But that is certainly a piece that maybe not necessarily the changeover in the House, but some other things that could come from that.
All right, so that's on the political side of things. Let's go a little bit more global and macro, so to speak, the emerging markets. As we take a look at how things are shaping up, we found a bit of a near-term bottom, at least. We don't know what the future will hold, but it feels as though some people are dipping their toes back in. Has the emerging market trade played out enough where people can feel comfortable now starting to take a little leg into positions on that side of things because things have been so beaten up?
Yeah, I mean, I think if you're underweight emerging markets, I think it is worth looking at. I'm not ready to go overweight there yet. But I think the value is interesting, and certainly if you're a believer like I am that the global economy is going to continue to grow, I think it makes sense to be there. I think you just continue to probably, as you know, you'll probably see some more volatility. We still have a lot of countries, like Turkey, their problems aren't solved. Luckily, they're such a small part of that emerging market index that in and of themselves, they're not that meaningful. But I think, in China, certainly that's the one to watch. We get PMIs at the end of the week. That continues to have a bit of slowing, which is obviously concerning.
Bill, if you look at that global economic data as it's shaping up right now, you mentioned that emerging markets are not really an overweight for you just yet. Are there places that you are recommending people still go into or should overweight or put positions in if they don't already have them right now?
I mean, I think in terms of internationally, I really like Japan. It is exposed to the trade, any sort of trade conflict between the U.S. and China. But the difference with Japan is, and it's really exposed to global growth, but the difference with Japan is you do have companies that are typically, on the whole, very solid. They typically hold a lot of cash, even more cash than the U.S. companies hold, growing dividends. I just think it's a spot much cheaper than the U.S., something like 12 times earnings instead of 17 times earnings. And I think that is a place to look. And shockingly, I think overlooked.
Bill, before we let you go, it sounds like you're resoundingly positive on what's happening with the market. You're constructive. Is there any potential downside? What's kind of the thing that we're not watching for that could really derail everything here?
I think a couple things. One is, as you know, when things get too good or too happy, of course, any sort of little, blip becomes a problem. So I am watching, if we get maybe some really bad news again on the trade front, say with China, I think that's another blip that could show up. I do think, you got to watch the yield curve. I know a lot of people talk about it. I don't think looking at the 10-year minus the 2-year signals the end of doom if it does invert, because I think there's other things going on. But that being said, I wouldn't be surprised if the market reacts, though, to it. And that's what does matter. So I think there's a couple things to keep an eye on.